Hi guys, welcome back. So we already started the discussion on capital budgeting in the previous video. Remember, capital budgeting is the process of making long-term investment decisions. Previously, we have discussed how to calculate the year zero investment, the year zero outflow, which we call the net investment. This is the payout that we need to make now in order to reap benefits in the future. For this video, we are going to talk about the cash flows to be generated as a result of that investment. The cash flows to be received in year 1, 2, 3, etc. and so on. We call this after-tax cash flows. But let us have one step backward and answer this question. For the purpose of evaluating projects, which do we prefer? Accounting profit or cash flows? To answer that question, we must understand the problems associated with the accounting profit. If we are going to notice, a firm's accounting profit can actually change if you are going to change the depreciation method or if you're going to change the inventory valuation policy. Notice that we can change the accounting policies and have a different profit. This is not true for cash flows. For cash flows, if you have a cash inflow, that's an inflow. If you have a cash outflow, that's an outflow, regardless of the policy that you are going to set. Second, at the end of the day, it is actually cash flow that matters. Imagine if you own a house which you are going to live for 5 years. The value of the house went up from 1 million pesos to 3 million pesos in that 5-year period. If that's the case, you're not going to feel that gain, that accounting profit, just because the house's value went up. The only time that you're going to feel that if you're going to sell that house, in that case, it is because of the cash inflow. So in answering the question, we prefer cash flows to evaluate investments. We prefer cash flows to evaluate capital projects or long-term investments. But how are we going to calculate these cash flows? Let us refer to the following sample case. Hope Tech is considering an expansion project. The following income statement items are expected to materialize if there is no expansion and there is an expansion. So if you're going to look at the items, they would change if we're going to make an expansion. Sales will go up from 9,000 to 12,000. Cash expenses from 6,000 to 6,900. And depreciation from 1,500 to 2,100. Let us arrive at the accounting profit and then we are going to reconcile it with cash flows. Scenario 1, we're going to assume that there are no taxes involved. What would be our incremental cash flows? Okay. As a result of the expansion, we are going to notice that sales revenue would go up. So we would have an increase in sales revenue from 9,000 to 12,000. That's 12,000 less 9,000. We will have an incremental revenues of 3,000. As for our cash expenses, we're going to have an increase from 6,000 to 6,900. So that would be 6,900 less 6,000. That would give you an incremental 900. So we have an incremental cash revenue of 3,000, cash expenses of 900. That would give us a net 2,100. We call this the incremental before tax cash flow. Incremental before tax cash flow. Now, what else would affect income? Of course, depreciation. we would have an incremental depreciation. Without expansion, our depreciation would be 1.5, but with expansion, it becomes 2.1. So we would have 2.1 less 1.5. We would have 600. 2.1 minus 600 is 1,500. This is our incremental profit. 1,500 incremental profit. Now, if our profit is 1,500, how would we arrive at our cash flow? What we basically need to do is to simply add back the expenses that do not constitute a cash outflow. Yes, I'm talking about depreciation. So adding back depreciation, which is 600, we are going to receive an after-tax cash flow of 2,100. Take note, it doesn't matter when we call it after tax or before tax, considering that we are not assuming taxes yet. So our cash flows would be 2,100 in that year. Now, if you are going to notice, you do not need to go through the process. Your after-tax cash flow will simply be equal to your before-tax cash flow of 2,100. 2,100 is simply your before-tax cash flow. So assuming there are no taxes, do not waste your time considering depreciation. Just combine the net impact of your cash revenue and cash expenses. You have your cash flow. Next scenario, we are going to assume a 30% tax rate. The company is subject to a 30% tax rate. How would our analysis differ? We can go back with our original analysis with the incremental revenues, cash expenses, and depreciation still the same. What we will have here will only be the incremental profit before taxes, 1,500. If we're going to assume taxes in the equation, we are going to deduct taxes, incremental taxes, which is at 30%, 450 here. So we are going to have an incremental profit after tax of 1,050. Incremental profit after tax of 1,050. That would be our profit if we assume a tax rate of 30%. So in arriving at the cash flows, the same process, all we have to do is to just add back the expenses that do not constitute a cash outflow. That is depreciation. So if we want to arrive at the after-tax cash flow, just add back depreciation, which is 600, and that would give us 1,650, your incremental after-tax cash flow. Again, your incremental after-tax cash flow is 1,650. So, how do we arrive at the cash flow? From profit, just add back the items that are deducted as an expense but do not constitute a cash outflow. That is most commonly depreciation and sometimes amortization. However, this is a very long process and I know you want a shorter way to do it. So how do you arrive at the after-tax cash flow? Your after-tax cash flow can be arrived at by taxing your before-tax cash flow. Before-tax cash flow times 1 minus T. Let us try. Our before-tax cash flow is 2,100. Let's tax it times 1 minus 30%, the tax rate. That would give us, yes, you're right, we are wrong, 1,470. Not the answer that we are expecting. Why? Well, we tax the before tax cash flow, but what we should tax is only the profit before tax. In essence, the recognition of depreciation help you reduce the tax base and therefore reduce your taxes. That is, your depreciation has given you a tax savings. We call this the depreciation tax shield. How much? An amount equal to depreciation times T. Depreciation in our case is 600 multiplied by 30%. And that would give you 600 times 0.3, 180. If we're going to sum up 1,470 and 180, we are going to get 1,650. Our after-tax cash flow, 1,650. So here's the shorter way of doing it. Just tax your before-tax cash flow, BTCF times 1 minus T, and then add back the depreciation tax shield. So what are we going to discuss in the next videos? Well, we are going to talk about the capital budgeting techniques, also known as the capital budgeting models. These models are intended to aid us in making long-term investment decisions. Are we going to accept this project or not? The capital budgeting techniques will help us.
Wow!
The capital budgeting techniques that we are going to talk about would include the accounting rate of return, the payback period, the net present value, the internal rate of return, and the profitability index. Of all of these models, the accounting rate of return is unique. Why? It is the only model that relies on accounting profit, while the other models, we are going to use cash flows. So stay tuned. For our next So stay tuned. Bilang lang ba? Pangilan ba to? 50. Like, share, and subscribe.